Good morning. It is a new week. It is Monday, April 4th, 2022. Futures are up 0.18% on the S&P 500. That follows a move higher on in volatile trading on Friday, where the stock market was up about 0.28% if you're looking at the S&P 500. But if we go back to Friday, trucking stocks and railroads both fell. It was the worst day in freight actually since June 2020. There were concerns about a decline in freight demand that really manifested itself as a result of the curve inversion, this yield curve inversion, where the 2-year interest rate is higher than the 10-year interest rate. And that has a lot of people concerned about recession, and it has people concerned, especially if you're looking at recession. The biggest areas that are impacted by that tend to be freight. It's a very cyclical sector. It's very GDP sensitive. So if you're concerned about recession, then you got to be concerned about freight as well. I would say I think that there are reasons to think that, the curve inverted in 2005, 2004, 2005. We didn't have a recession until 2008. It's not a great predictor of timing. It basically says that, when the yield curve inverts, at some point we will have a recession, but that's also kind of a fact of life. At some point we will have a recession. There are some other reasons for the reasons trucking stocks and railroads fell. For example, retailers are making progress restocking inventories. That's a good thing. So we have that going for us, but that is reducing some of the onus and kind of that surcharge that you'd be paying the truckers in order to get those goods to the store at in a quick fashion. So you don't have to pay that premium to get very fast freight. You can afford to take your time a little bit more because that inventory is being restocked. The second point is that the Fed is removing liquidity, but we've known this for some time. The Fed has actually been removing liquidity since last year when they started the taper program. Now they're raising interest rates, and I would expect them to continue to do that. Having said that, I don't think a 0.5% interest rate increase is going to reduce the amount of goods Americans purchase. I think that's more an optics impact than a actual consumer spending impact. The third piece, though, I do think is taking place. I flew to Florida over the weekend, and I don't know if I've ever seen the airport that crowded. Admittedly, it was spring break, but the airlines were packed. The airports were packed. The airlines were having actually real trouble navigating through that. It seems like they were having difficulties adapting to the volume of passengers that were traveling. And we are seeing that spending shift a little bit from goods related spending, I think going to Home Depot, going to Target, to travel and entertainment. People are traveling. In fact, Andrew's traveling right now. He's actually driving. They're going up with the family for spring break to Gatlinburg. But you're having this shift from goods spending to travel and entertainment spending. And then the fourth piece is you do have higher fuel prices, which is going to be negative for truckers at the same time where you have incremental capacity coming online. And I think that will be negative for trucking stocks. So trucking stocks have enjoyed an extremely strong time where there's unprecedented demand for their services, and I think that's going to begin to normalize. And I think that's one of the things that manifested itself on Friday. I think the Friday move was a bit extreme, but I do think that you had a lot of these factors coming to a head on Friday. Staying on the larger economy side, Jamie Dimon, the CEO of JP Morgan, came out with his annual letter this morning. Actually over the weekend, and he touched on many different aspects of things. He touched on geopolitics, he touched on the economy, he touched on the markets. On Russia, he said that the US should increase sanctions in whatever way national security experts recommend to maximize the right outcomes. I think we would all agree with that. So he's not really saying anything new with that. He said that the US does need to be prepared for a long and unpredictable outcome, and JP Morgan could lose $1 billion over time. So he didn't quantify how long that time period would be. If it's a long and unpredictable war, then maybe we're talking 5-10 years. I hope that's not the case, but I don't think Jamie Dimon has a particular insight to that other than just looking at history. On the central banks, he says that rates will continue to rise and they might rise substantially. He says the current tightening cycle is no way traditional. And he says that he does not envy what the Fed does next. He says that if they manage things correctly, we could set ourselves up for years of growth and inflation that will ultimately recede. But we could have some volatile markets in the near term. And what he said on that is specifically is that there are challenges at every turn. And especially with this rate hiking cycle, it's going to create some volatility, and that changes from what he said last year. Last year, he said that we're set up for a multi-year economic boom. He does say that American household finances are in great shape, but we do need to restructure some supply chains. Countries that will benefit from that include Mexico, Canada, Brazil, basically friendly countries who are willing to negotiate not only economically with us, but also militarily and strategically. And I would agree with that as well. So I think he summarized a lot of what we see and what we're seeing across the world. And I think he does it in a fairly concise way. It's a 44-page piece, which is smaller than his 65-page letter last year. But I think it was a good letter that he wrote. And I think a lot of the points that he points out are fair. I think that he's very focused on fast pace of interest rate increases. I think that might ultimately prove to be excessive, but we'll have to see what happens with that. He's certainly been right so far. Elon Musk took a 9.2% passive stake in Twitter. So that stock is actually up significantly this morning. He said that last week he polled his 80 million Twitter followers and asked them if Twitter adheres to the principles of free speech. Over 70% said no, Twitter does not adhere to the principles of free speech. He said that a new platform might be needed. This comes on the heels of Jack Dorsey, the former CEO, resigning in November. And I think that Elon Musk may want for a different social media platform. We already seen a different social media platform, of course, Truth Social, which rollout has been significantly slower than anticipated. But if Elon Musk and his billions are powering a new social media platform that could compete with Twitter, that could be something to watch going forward. But there's no sign of that right now. And in fact, Elon Musk owns almost 10% of the company. Starbucks, in another CEO move, their founder's back, Howard Schultz, and he is canceling the stock buyback. The stock's down 2.8% this morning. It's his first day back as CEO following the departure of the previous CEO, Ron Johnson. And he says that by canceling the share buyback, it'll allow us to invest more into our people and our stores, the only way to create long-term value for all stakeholders. I think that's an interesting point. I think it's optically important more than actually financially important. Starbucks does have some good cash flow. They are a very profitable company and they're not significantly over-levered. And so I think that this is more a sign by Howard Schultz that they're going to put the people first over the shareholders. And I think that the shareholders should be aware of that and know how Howard Schultz operates as CEO, and that's how he operates. And then we'll just finish off by previewing the week ahead. We will have Tom back tomorrow, so we'll talk a little bit more about interest rates on that call, which will be important because on Wednesday, we get the minutes from that Federal Reserve meeting where they hiked interest rates a few weeks ago. And we'll be looking for some signs that will do a 50 basis point interest rate increase at their meeting a month from today. Tomorrow, we have an Analog Devices Investor Day. That'll give us a really good read on whether or not a lot of these chips that have been in short supply are starting to come to market a little bit faster. We have the ISM services report. We had the ISM manufacturing report last week on Friday. That was a little bit disappointing in terms of the headline number. They did see a lot of inflation as well. So we'll see the ISM services report And I would expect that we're going to continue to see this shift from goods to services, so that services number might actually beat expectations. And then Thursday morning, we have Constellation Brands earnings. That's the maker of Corona, Modelo, Pacifico. They will be reporting earnings for Thursday morning for the quarter that ended at the end of February. So they're getting ready for the summer season and Cinco de Mayo there. So with that, I'll leave it there. Again, Tom will be back tomorrow. We'll give you a good recap of interest rates, and we'll start previewing earnings reports as well, because they're going to start coming in beginning next week. That said, have a great week, have a great day, and we'll see you tomorrow.